Have you ever thought about a single financial event, maybe one you haven't even heard much about, that could quietly shift how money works across our entire system?
It's a fascinating thought, isn't it? And
Yeah.
we might be looking at something just like that right now.
Exactly. We're doing a deep dive today into something pretty significant, a potential dividend payout from the Reserve Bank of India, the RBI, to the government.
And the numbers being talked about are, well, quite staggering. Somewhere in the ballpark of 2.7 to euro lakh crore.
3 lakh crore rupees, it's hard to even picture. And look, this isn't just some accounting detail for the government's books.
Not at all. A cash injection of this sheer size, it could really ripple out, impacting interest rates, market liquidity, different sectors, the whole lot.
So where are we getting this information?
Our main source today is a report from Front Wave Research. It came out Thursday, May 15th, 2025.
Right, and they're the ones highlighting this potentially record-breaking number and digging into what it could all mean.
Precisely. So our mission here is to unpack that. We want to understand, what's behind this potentially huge payout.
And what effects it might have on the markets, on the economy, and ultimately what it means for you listening in.
Let's start with that number again. 2.7 to 3 lakh crore. Why is that figure causing such a buzz?
Well, it's the scale, isn't it? The report really emphasizes this point. We're talking potentially almost 50% higher than last year's dividend.
Which was already a record at 2.1 lakh crore. So a 50% jump on that. Well, it's massive.
Huge. And the expectation, according to the report, is that we'll likely hear the official announcement from the RBI by the end of May.
That seems to be the timeline, yes, late May.
Okay, so nearly 50% more than last year. What on earth is driving such a colossal surplus at the RBI? Where's all this extra money coming from?
Right, good question. The Front Wave report points to a few key drivers. First off, and this seems to be a big one, profits from their foreign exchange trading.
Managing the rupee dollar rate?
Exactly. It looks like the RBI was strategically buying U.S. dollars when the rupee was, say, around the 83, 84 mark,
Okay.
and then selling them when the rupee strengthened, maybe in the 84, 87 range. These kinds of moves, if timed well, can generate pretty substantial gains.
So smart trading, basically. Buying low, selling high on a massive scale. What else contributed?
Another major factor is simply earning more interest on their foreign exchange reserves. Remember, the RBI holds a huge amount, over $600 billion worth.
Right.
And with global interest rates being, well, quite elevated recently, the returns on those holdings would naturally be much higher than in previous years.
Okay, so higher interest income from their massive reserves. Makes sense.
Anything else? The report also mentions sort of their bread and butter domestic operations, earnings from the government bonds they hold, and income from managing day-to-day liquidity in the banking system through things like repo operations.
Got it. So it's a combination. Clever forex trading, higher global interest rates, boosting returns on reserves, and their regular domestic income streams.
That seems to be the picture, yes.
Okay, that helps understand where the money is coming from. Now, what happens when potentially, 3 lakh crore moves from the RBI's account to the government's? The report calls it a stealth stimulus. What do they mean by that?
Well, think about it. When the RBI pays this dividend, the government receives the funds. Eventually, the government spends or invests this money.
And it flows into the economy?
Precisely. It gets injected into the banking system. So even though it's not, say, an announced government spending package, this transfer acts like a stimulus by significantly boosting the overall liquidity.
Liquidity meaning the amount of readily available cash sloshing around the bank.
Exactly. The readily available funds in the system.
And the report actually tries to quantify this potential surge in liquidity, doesn't it? What kind of numbers are we talking about?
Yes, the projections are quite dramatic. Banking system liquidity, well, it's recently been in deficit, meaning banks were actually short of funds on a net basis.
Right, I remember hearing about that tightness.
Well, this dividend payout, once it happens and the government starts using the funds, could potentially flip that deficit into a huge surplus. The report estimates maybe 5.5 to 6 trillion in system liquidity.
Hold on. From a deficit to a 5 or 6 trillion rupee surplus, that is a monumental swing.
It really is a very significant shift in the underlying plumbing of the financial system.
So markets anticipate, right? What's the immediate reaction we're seeing, or that the report highlighted in expectation of this? It mentioned bond yields.
That's right. The bond market is definitely forward-looking. And the expectation of all this extra cash hitting the system is already pushing bond yields down.
Lower borrowing costs for the government, essentially.
Yes. The report specifically noted the yield on the benchmark 10-year government security, or GSEC. It had already dipped below 6.3%. I think it hit 6.23% around the time the report was published.
So yields falling because the market thinks there's going to be plenty of money around to buy bonds.
That's the dynamic. More demand for bonds, or rather more anticipated cash available, pushes prices up and yields down.
And it wasn't just the 10-year yield, was it? The report mentioned something about the yield curve steepening. What does that tell us?
Ah, yes, the steepening. That's quite interesting. Basically, it means shorter-term bond yields are falling faster than longer-term ones.
Okay, why is that significant?
Well, often when you see the short end of the curve falling sharply relative to the long end, the market interprets it as a sign, a signal that maybe, just maybe, the central bank, the RBI in this case, might be leaning towards cutting interest rates sooner rather than later, or at least less likely to hike them.
Because all this extra liquidity primarily impacts the short-term money markets first.
Exactly. It puts downward pressure on those near-term rates quite directly.
Interesting. So this dividend isn't just a one-off cash transfer. It could have these knock-on effects, potentially influencing expectations about future RBI policy, too.
It definitely seems plausible.
How else might this reshape the bigger financial picture? What about government borrowing plans, for instance?
Well, if the government gets this much larger than budgeted surplus from the RBI, it logically reduces their need to borrow from the market, right?
Ah, so they might issue fewer government bonds than planned.
Potentially, yes. It gives them more fiscal breathing room. They might trim their borrowing calendar for the rest of the year.
And what about the RBI's own monetary policy stance? You mentioned the potential signal from the yield curve.
Right. The report suggests that if inflation stays relatively benign, they mention a figure around 3.3%, then this huge injection of liquidity might make the RBI more comfortable maintaining what's called a dovish stance.
Dovish meaning leaning towards lower rates, or at least not hiking them.
Correct. It reduces the pressure or the perceived need for tighter monetary policy, assuming inflation behaves. More liquidity generally eases financial conditions.
Okay, so potentially less government borrowing, maybe a slightly more relaxed RBI. Sounds like a favorable environment for some. Who stands to benefit most here? The report singled out some sectors, didn't it?
It did. With ample liquidity and potentially lower interest rates, several areas could see positive impacts. PSU banks, the public sector banks, were highlighted.
Why them specifically?
Two main reasons. One, they often hold large portfolios of government bonds. If yields are falling, the value of those bonds goes up, leading to treasury gains on their books.
Okay, paper profits on their investment.
And two, in a more liquid system with potentially lower rates, they might find it easier to grow their loan books, more lending activity.
Right. What other sectors?
NBFCs, non-banking financial companies, and housing finance companies were also mentioned. For them, the big potential benefit is lower funding costs.
Cheaper for them to borrow the money they then lend out.
Exactly. If their cost of funds goes down, their profit margins or spreads could improve quite nicely.
Makes sense. Any impact on the sort of real economy sectors, manufacturing, infrastructure?
Yes, absolutely. Capital goods and infrastructure sectors could get a boost. The thinking is, if the government has more fiscal space, thanks to this dividend,
They might spend more on public projects. Roads, railways, power.
that's the potential link. More public capital expenditure. And then there's consumption.
How does that benefit?
Well, cheaper credit generally encourages borrowing and spending by individuals and businesses. Plus, if the government uses some of its extra funds for, say, rural support schemes, that could also boost demand, particularly for consumer goods.
So quite a wide potential ripple effect. Banks, lenders, infrastructure, and even consumer spending. The report also mentioned foreign investors, I think. What's the angle there?
Yes, it noted a recent trend where foreign investors have actually started buying Indian assets, again becoming net buyers.
Why now?
The report suggests it's likely a combination of factors. Falling bond yields here might look attractive compared to yields elsewhere, and just the general perception of macroeconomic stability in India could be drawing them in. This potential liquidity boost probably doesn't hurt that perception either.
So maybe international money is also anticipating this smoother liquidity environment.
It could well be part of the calculation, yes, adds to the overall positive narrative.
Taking all this together then, the report seems to paint a picture of the Indian economy being in a reasonably decent spot right now.
That seems to be the overall assessment in the front wave report, yes.
Yeah.
They summarize the current conditions as sort of a sweet spot.
How so?
Well, you've got relatively soft inflation, Real interest rates adjusted for inflation are actually quite high, which gives the RBI room.
Okay.
You have this shift we've been discussing from tight liquidity potentially towards very easy liquidity. And importantly, corporate earnings have generally been holding up well. They've been quite resilient.
So inflation under control, high real rates, liquidity easing, and companies still making money. It sounds quite positive.
Certainly a supportive backdrop described in the report, yes.
Okay, so let's try and wrap this up. The main takeaway seems to be that we could be heading into, or perhaps are already entering, an environment defined by high liquidity and potentially lower interest rates.
Driven in large part by this potentially massive dividend payout from the RBI.
That seems to be the crux of it, a huge influx of funds that could reshape market conditions and have broader economic effects.
That's the key message coming through from the research.
Which really brings us to the final thought for you listening. Given everything we've discussed, this potential liquidity bomb, the falling yields, the sectors that might benefit, what does this mean for you?
Yeah, how might these shifts create new opportunities or maybe even some challenges in your own world, whether that's professionally or just in how you think about your personal finances?
It's definitely something to mull over. How could this wave of liquidity change things beyond just the financial headlines we've talked about today? Food for thought.